You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
Welcome back to the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the amazing developments in the world of options and explain how you, the busy financial advisor, asset manager, wealth manager, could utilize those in your portfolios. My name is Mark Longo from the optionsinsider.com, as well as from, of course, the ever-expanding, ever-exciting Options Insider Radio Network. 13 different programs on said network, including many, many archived episodes of the Advisor's Option. If you want to check those out for yourself, a lot of places you can go to find those, including the mothership, the flagship, theoptionsinsider.com. Surf on over there, click on the Insider Radio Network tab, and you're pretty much off to the races. You can see all of the content there yourself, all of the episodes, and you could read along, full show notes. We've actually added full show notes for you guys who want to scroll through and see everything we discussed on an episode before you pick that one. You can now do that. It's all baked in there for you. This is episode 32, actually. So we've been doing quite a few of these now, which is always fun to see what's cooking in the land of the wealth advisors, the asset managers, and how, of course, you can apply the options expertise that we bring here on the program. Of course, you can also find this program iTunes, Stitcher, TuneIn, pretty much wherever you find your favorite podcast programs, or just grab our mobile app available for iOS, Android, and the Fire OS. All right, and joining me on the old program today, we have the COO and co-portfolio manager over there at Swan Global Investments. He is Rob Swan. Rob, welcome back to the program. I believe it's been a while since you've been on.
Yes, it has. I appreciate the opportunity to come back. I'm super excited by your topics of conversation today. Everything is really tied into what we do on a daily basis, so looking forward to the program.
Yeah, I'm looking forward to as well. A lot of good stuff to get to, so without further ado, let's dive right into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
Welcome to Options 101. This is indeed the portion of the program where, as the name implies, we break down a basic options concept that you guys can then turn around and utilize in your own client portfolios. And today we were talking about what would be a good topic to address here on the show, one we haven't touched on in a while, and one we've flirted with many times and discussed various strategies, but never how they apply to this particular scenario, is, of course, one that I know a lot of the high net worth managers out there are dealing with on a regular basis, is that a client comes through your door and he's a successful executive in company X or whatever the case may be, and he has a concentrated position in the firm that he either started or works for, whatever the case may be. A lot of stock, a lot of options in that one particular name. And so, as you might imagine, and as any good financial advisor, risk manager would do, they would look at that and say, wow, that is a very, very highly concentrated source of wealth for you. Of course, that provides a very large component of risk to a portfolio. So as any good advisor would do, they would try to adjust that. Now, a lot of clients, they obviously can't sell those concentrated stock positions. They can't do a lot with them except for hold on to them until they retire or until they step down from the company. And so that proposes a very difficult challenge for a lot of the advisors out there. What do they do in these scenarios? And as luck would have it, as fortune would have it, this is actually an ideal scenario for options, for the products we talk about here on this program on a regular basis. When someone walks through your door with a large concentrated stock position, you as an options-oriented financial advisor, asset manager, wealth manager, you should have a big smile on your face, because that's pretty much the ideal scenario for you as the options-oriented advisor. So there's a lot of different strategies we can get into. Before we even do that, Rob, is this a scenario you guys encounter a lot over there at Swan? I know you obviously do the overlay business over there, and you obviously deal a lot with the mutual fund and applying that to the variety of people who want to take part in those funds now. But do you have a lot of people, or maybe in the early days of Swan, did you have a lot of people come knocking on your door and saying, hey, I have many, many shares of whatever, Apple, XYZ, and did you have to construct kind of these types of situations that we're dealing with now here on the show?
Absolutely, and that aspect of our business is starting to grow, maybe one of the fastest growing areas of our business. There's a lot of concentrated positions. There's also a lot of managers out there who have a collection of concentrated positions that they've a really low cost basis. And so we, at Swan, we perform an overlay analysis to try to find an appropriately correlated hedge. And then we typically run our standard income trades on top of it as our overlay. There's some unique things that you're probably going to need to differentiate. Having somebody who's got a low-cost base of stock is not the same from the point of view of whatever hedge you may decide to put on, but because of the fact that with a concentrated position for a CEO, they're likely not to be able to purchase puts or short the stock. It's a conflict of interest. So finding something that's an appropriately correlated hedge on such of an overlay portfolio is one of the things that Swan does as part of its overlay program.
That's a good point, and one we have here to address here on the show, because the simplest, most straightforward approach to that is what you just mentioned, the basic protective put. But you're right, a lot of executives do have a prohibition that they can't do that. Thankfully, I think that's starting to lessen in some scenarios. I think people are starting to see a bit of a differential between the hedging type activity that we're talking about here and just straight up selling of shares and things like that. So it seems to be lessening a little bit, but on the other hand, it is still, you're right, a problem for a lot of the people out there. That said, we're going to start off with that very basic component. Let's say a client walks in who has a concentrated position, and maybe for some reason they don't fall under that prohibition. Then, of course, the most basic position we talked about probably on one of the first episodes of this program would be a good way to start. That is, of course, the simple basic protective put. Let's walk through an example right now. Let's say a client walks into your office. He's got 10,000 shares of everyone's favorite stock, XYZ. let's say he bought it from, or he was assigned those shares from 35, and now that stock is trading 100. He has a concentrated position. For some reason, he can't divest of it. Maybe he's afraid of taxes in this scenario, which is also a very common scenario with some concentrated positions, and why people don't want to adjust or sell them. It's because they have accrued a lot of profits in there, and they don't want to take the tax hit yet, or they can't take the tax hit yet. So that's another scenario. It's not just executives, but that is a significant portion of them. So this position, 10,000 shares of XYZ stock trading around 100, of course, worth about $1 million. In this scenario, it's pretty much the entirety of this client's portfolio, and he doesn't want to sell it for a variety of reasons. Looking out, you could do a lot of different things. We chose in this scenario just to structure it very basic, very straightforward, which is the way a lot of advisors like to approach things, a little bit more longer term, a little bit more set it and forget it. And in this example, we look at a 95 strike put. Let's say it's trading for about $5 for a 1 year output. He needs to buy, of course, 100 contracts to protect those 10,000 shares. So a little basic math, of course, every options contract, at least on the equity side of the fence, is for 100 shares. So a few multipliers there works out to $50,000 he has to pay for that, which works out to about 5% of his portfolio. That's a substantial outlay. And let's say if you're an advisor, you may be leery of that cost. And for that benefit, or excuse me, for that cost, what do you get? Well, of course, you get stopped out effectively at the price of $90, which is the 95 strike price that you bought minus the $5 you actually paid for those contracts. So the effective stop out price there is $90. And that's certainly an effective way to go. But of course, as you can see from that basic example, and these are actually numbers we pulled from a variety of different $100 price range stocks that are floating out there. So they're very, very close to what you might see in the marketplace. It's a pretty expensive one. You're essentially talking about giving up 5% outlay and being stopped out 10% down in the marketplace. So there are some advisors who may balk at that, and quite rightfully so. Say, hey, that's a substantial amount to outlay. So, but that's our basic position. We kind of wanted to start there before we start moving into some more advanced things. And Rob, we're going to move into some more advanced things to get the ball rolling here in a minute. But before we even do that, do you, when someone comes in and let's say they fall outside that prohibition where they can't structure that. Oh, I know you guys do a lot of longer term puts over there at Swan with your overlay portfolio, and you do some other things to try to pay for that. Is that an approach you guys would take for a high net worth individual, the concentrated stock position as well? Would you buy, I think you guys like 2 year outputs in the overlay. Would you take that similar approach in the individual case, or would you kind of take it more on a custom case by case basis?
So we do apply the same approach regardless. We basically believe that depending on the liquidity of the particular underlying, the options on that underlying, that is going to determine what we're looking at in terms of buying a longer-term put or, let's say, a 1 year put like you're looking at here. Our view on the longer-term put is that the time decay, while it's an initial higher outlay of monies and allocation to that longer-term put, we are staying in a much lower depreciation area. So your 5% depreciation. So if the stock stays flat, does not or goes up at all, you're going to lose 5% of the portfolio on that hedge. And so we're looking to reduce that with our longer term puts into the 3% range. But this is completely in line with what we would expect. And as I said, we would choose the time duration of the put we're buying based on really the liquidity of the stock that we're trying to hedge here, or the options on the stock.
Yeah, that certainly is a valid approach because, as you might imagine, and listeners, you may know, the farther away you get from front month at the money and a lot of options, the less liquid, the wider the markets are. And so it can be an issue if you see 1 month trading slightly more liquid, a little bit tighter than another. That could certainly be more attractive for how you structure the portfolio. So that's pretty much the most basic, most plain vanilla thing you could do. Someone walks in the door, they've got a bunch of shares XYZ. Here you go. You go buy them a put. And it's a 1 year put. Pretty straightforward. Not a lot of nuance to it. And as Rob kind of alluded to, and we've said many times here on the show, the purchasing of the put, where you pick that put, that certainly is a component of the analysis and an important one. But I think a lot of people will come to realize after time of doing this that a lot of the expertise in the option space comes not from just picking the strike and constructing the hedge. It's finding a way to actually, as Rob alluded to pay for that protection, because anyone can go out and just spend 5% of your portfolio every year and buy the hedge, and that's kind of it. And that's really not a high level of service, not a high value added that they're bringing to the table. They're hedging you, of course, but it can be done more effectively, and that's kind of where we're going to get to now, some of our further iterations. Now, the first iteration we would take of this, and the one that I've jokingly, but only really half jokingly, referred to on this program in the past as the holy grail of the options market, or the advisor market really, is the collar. And if you want to learn more about this in particular, I suggest you go off to that episode where we talk about that in particular, and see if I can pull up the episode number for you right now. This was back when, I think one of the first times Randy joined us on the program was around episode 4. It's called The Holy Grail of the Options Market, if you can't find it, and that is our episode where we break down all of the different aspects of the collar. So tune into that if you want more insight and analysis from us and Randy and the gang on collars. But a quick overview for those of you. Again, we're going to construct the first part of it very similarly to the basic protective put. You have the same 10,000 shares of XYZ stock. It's still trading for $100. It's net worth $1 million. You come out, you still buy that same 95 strike put for $5. You net outlay $50,000, 5% of the cost. That's the first part of the collar. But now you turn around and say, that's expensive. I don't really want to pay all of that. What can I do to avoid paying all that and still give myself some ownership in this company? Obviously, I can't sell this position, but give myself some appreciation potential in this underlying. And that's where the second part of the collar comes in that's so attractive to people, because it combines the second position that a lot of financial advisors, asset managers really like. That is indeed the covered call, a very popular income trade. So now you turn around and, let's say in this scenario, we bought a longer term put. Now we're going to focus on the nearer portion of the curve, that near exponential portion of the decay curve, when you're writing our covered calls. In particular, we chose in this example a front month, 1 month out covered calls. You can see a lot of great data on this if you surf on over to our other partners on this show, the Options Industry Council. They have a lot of great data, including a study called Tightening the Collar and Collaring the Qs. A lot of great studies on how to set up collars for the most optimal return, both risk adjusted and total return, on a variety of different underlyings, indices, equities, commodities, you name it. So if you want more data on collars and how to structure them, by all means, check out those studies. Here we've chosen the front month call versus the longer term put, and that really maximizes what Rob was talking about before, that decay impact. You're lessening it on the long portion, which is what you want, the of course long premium portion, and you're maximizing it on the short premium portion. Let's say in this scenario you can sell that 1 month $5 out of the money call for about 50 cents. So that gives you $5 of appreciation to the upside, and in return for that you're collecting 50 cents. Now of course 50 cents, that turns out about $5,000 you can generate on the full amount, the 100 contracts you're going to sell monthly, which in turn annualized works out to roughly $60,000, depending on, of course, you're never going to sell that same call for the same level every month, but somewhere in that ballpark. So you can see now you had a net outlay of about $50,000 in your portfolio, and now you're turning around and selling, collecting actually potentially more over the course of that year worth of income in that position. So it's an attractive thing for a lot of advisors, because now you've protected yourself for a year, and you've also financed that, perhaps fully, perhaps even collected a credit if you've done it right. So it's a very attractive thing. And before I get into the pros and cons of this, Rob, anything you want to add on collar construction? I know this obviously is a portion of what you guys do as well with the overlay. Obviously, you have that collar version as well. You guys do things a little bit differently over there. So any insight you want to add here on the collar and how you can tune it, or perhaps fine tune it for some concentrated stock positions?
Well, the first thing I'll point out is that what you're describing here in terms of changing the expiration for what you're selling and buying, we 100% agree with you that you should take advantage of the stability and lower price. For everybody believes that 1 year from now, 2 years from now, that everything is going to be better in general, and so we think that longer term options are a much better value. So the fact that you didn't change this collar to actually be, let's say, buying 1 month protection and selling 1 month, out of the money calls. A lot of the competitors that are out there, if you look at, things like Gateway, for example, there's some other collar funds or collars with kicker funds that have actually recently launched, and everybody seems to be tying the hedge to the same expiration of what they're selling. And I think they're generally doing it on a quarterly basis instead of a monthly basis. That's probably the balance, because they're not willing to kind of divorce the hedge from the call, because they want to consider this to be, a collar, and they're managing, in a sense, that put in that call together. We separate them in the way that you did, and we think this is the absolute right way to do it. So I agree with exactly what you're proposing here. We do something similar. I think, you haven't gotten into the pros and cons here, but I think I have a comment on the con once you actually jump into that.
Well, let's get into that. And you also mentioned the other type of a collar. We'll get into that quickly, too, because that is something else we were going to, we had on our list to discuss the way some other people like to construct these collars. But before we get into that, you're right, let's get into the pros and cons. Obviously, the pro of doing a collar versus just doing the protective put, clearly you're generating income now from this position. So if that income works out as you expect, then you could offset a substantial portion, if not all, of the cost of that protection over the course of that year, and perhaps even collect some income to boot. And also, remember, you're writing that out of the money call. You can choose whatever strike you desire. We chose $5 out of the money in this case, so that still allows for $5 worth of appreciation, roughly 5% of the $100 stock. Obviously, it'll change as the stock rallies, but that $5 of appreciation a month could also turn into an additional about $60,000. So you could easily double the amount you paid for that put if you continue to choose those same strikes and get those same levels. So it's a lot of theoreticals in there, but you can see in practice that you can do something similar with a little bit of work. One of the downsides, and it kind of gets to what Rob was just talking about, one of the reasons some advisors choose not to go this way is because, as you can see, it requires a little bit more work, particularly if you have a client who's sensitive to selling the underlying. They can't do it. They have a prohibition against it, or they have a tax issue, whatever the case may be. They cannot let go of that underlying. Well, that means you're going to have to babysit that call a little bit. So you might be inclined to sell a little bit farther out of the money just to make your life a little easier. You probably don't want to do that. You want to generate the best returns for your client. But a lot of advisors say, well, I might just sell a 1-year call, set it and forget it kind of thing, and I'll collect more money up front and also reduce my babysitting work, because in this scenario, you're writing calls at least once a month. And of course, if the underlying does work out as you want it to, if it moves toward that strike, you're probably gonna have to roll a few times in there as well. So buy back that call you wrote, take a loss on that call position, and then sell it again in an additional month. That could be a lot of work for some advisors who have a lot of clients, and so that may turn them off. But at the end of the day, it's a value-added service that you're providing, and the more value you can add to your client at the end of the day, the better. I know, Rob, you have some comments you want to make on that as well about the higher level of the high-touch level, I guess you can call it, of managing these collars.
Right. So first of all, I think that if you go out and looked at a lot of the collar strategies that are actually being offered in, let's say, fund format, there is a lot more passive management of this call, and maybe that's why they try to move it out to be a quarterly type of call. But in their prospectuses, they discuss how if the market goes up more than this, then they're willing to truncate away all of the upsides. So they're not even willing to jump in and necessarily do this management to move the call out of the way. We happen to believe that active management is the best way to provide the best returns, risk-adjusted returns for your client, but it's a lot of work. And if you don't have the systems in place to be able to manage that across multiple accounts, multiple platforms, then you're likely to just short circuit the strategy a little bit and just say, I'm just willing, probability-wise, the market generally doesn't go up. In March case, 5% per month. So I'm willing to give, I want 5% per month, but if it goes up 8%, I'm only going to get the 5%. And so you give away 3%. We think long-term that's a bad way to play this. We think the active management is absolutely important. You obviously have to have the technology and the staff to be able to execute and monitor all those positions to be able to actively manage it. But truncating away all the upside just because it's less work for the manager is not a good trade-off. So, we like to see manager putting in, a lot of sophistication, a lot of investment in technology, a lot of investment in staff, because we want them out fishing for us, so to speak, and working those trades. Now, it could turn out that there's a lot of working and they end up breaking even on those trades every single month. And there was a lot of work that went into this with little or no return. You have to accept things like that, especially in a 2013 where the market is just one directional going up, 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 kind of inspired by the Fed, quantitative easing and monetary policy. That was really difficult and would have put a lot of pressure on any, especially passively managed collar strategy.
Yeah, the type of collar you're referring to there, Rob, is kind of colloquially known as the zero-cost collar. And it's done for the reasons that you describe, is that they try to set it up. They set it up one way, pretty much. They just want to set it and forget it, kind of. And you can certainly see the attractiveness to that approach, and from shall we say, the less active advisor. But it's usually the way these are done is usually, instead of the way we just talked about, where you push the buying portion of the collar as far out as you can, and you migrate the premium selling, the call writing portion of the collar, as close to expiration as you can, perhaps even for the more aggressive advisors, even into the weeklies, so that may be a step too far for some people, depending on their ability to manage the time involved. But still, that is definitely the best way to construct a collar for all the reasons we just described, in particular because you're maximizing your positions on that theta, on that time decay curve. And that's the way to really manage a collar. You want to pay as little theta as you can on the option that you're buying, and collect as much as you can on the option that you're selling. When you're doing these zero cost collars, then what you're usually doing is finding a put and a call that line up, so you can buy a put, sell a call, and they will offset each other to the point where you're paying very little, or zero often is the desired outcome for this collar. So you can see why that's attractive to a lot of managers, and the way Rob just described it. They'll set it up quarterly, find a zero cost collar, and do that 4 times a year for their clients. The problem is by doing that, you're not maximizing the decay curve. So what's happening there is you're usually finding options that are the same month, because that's where they line up usually the closest. So it's easiest to construct a zero cost collar all in the same month, rather than pushing that put out and the call up. And then also, as a result of doing that, you're going to have to choose not the strikes that you want, but the strikes that line up the best from a pricing perspective. And so when you're looking at price first, you're going to choose the less than desirable strikes. Maybe in this case, instead of buying the 95 strike put, you probably have to go down a little bit, maybe the 90 strike put, and maybe you have to sell a little bit closer to the at the money call than you really wanted to, so you're not getting as much potential for appreciation. So there's a lot of things that are less than ideal with a zero cost collar, and if you're going to take that approach, you really should consider that. It's attractive to pay nothing. I understand that. I understand the appeal of it. But when you think about it a little bit more, you actually will do better over the long term, actually spending some money for these collars and then writing these narrow term calls. And over time, if you do it well, you should collect enough to offset a substantial portion, if not all, of the cost of that put.
Yeah, and we would also reiterate, the active management where you're talking about getting away as the underlying rally is close to the call strike. That one might have happened every single month in 2013. And so without active management, not only are you going to have the depreciation of your hedge, which you don't use, you're also going to be losing on the calls, which are actually going to further truncate your upside each month. So you could end up in a 32% up year where you've only gotten 7 or 8% because you keep getting hit by these calls without active management. So we think there's a lot of value, and managers should be actively managing. They should not just settle for the easiest thing to implement. That doesn't necessarily benefit their clients.
Yeah, that's kind of been the way the business has been done for a long time, and hence the rise of the Robo advisor. We'll get into that in the buzz segment in a little bit, but managers are looking for a way to provide some value added that a robot cannot, an electronic platform cannot, and this is an ideal use case for that. Another way, Rob, to really kind of help pay for that protection on these concentrated stock positions is something you guys like to do. I know over there, I kind of call it loosely the collar with a kicker, which is instead of just buying the put and selling the call, you buy a put spread instead. So essentially you're buying a put, selling a farther out of the money put, and also selling a call. So the benefits of that should be relatively clear. You're selling 2 options, you're buying 1, so your net outlay is going to be reduced that much further. Of course, the downside, in this case quite literally, is that you're clipping your protection to the downside. So whatever strike you end up selling on that put spread, that's where your protection will end. So if you're maybe a concentrated stock position person, you're probably not maybe worried about your company going to zero. You have a pretty good insight into it. You have a pretty good understanding of this firm. You think you only really worried about a near-term correction. Maybe you're sitting on some profits. You want to protect those in the near term. Then a strategy like this could be ideal for you, because it allows you, again, to generate more income, to more easily pay for the cost of that protection. Of course, the downside, yet again, is the fact that if you are in a position where you're concerned about a company potentially going to zero, then maybe you might want to investigate the option to sell those shares, but also you'd probably want a little bit more open-ended protection. But I know, Rob, you guys utilize this as part of your portfolio overlay. So why don't you give our listeners some of your insight onto this, what I like to call the collar with a kicker, selling that extra put?
Right. So I appreciate that. So I would make a couple of distinctions here. There are some competitors of ours that actually will implement a collar with a kicker where they are basically not, let's say, buying a put spread, but they are actually, or they tie in the collar, they're basically tying everything to the same expiration. So if I use an example of a quarterly, they might be buying a quarterly hedge put. They're basically selling a put farther out of the money, as you described, which is what you're calling your kicker, and then they're selling a call. So under that scenario, because the put and the call are really, in the same expiration, I would look at that and say, I'm not talking about the hedge, but I'm talking about what you sold. I would call that a strangle. If you manage something as a collar, that's going to have different management rules, in our opinion, than managing something as a strangle with active management. We are more buy and hold. Put something on and forget it with our hedge, and then we are running independent market neutral income trades. So a strangle, when you sell a put and a call, you could basically have a market neutral scenario where the market stays within a normal range and you just let time pass and you collect the theta and you take that off. In the case where you have a kicker that you're talking about, but you do not actively manage it, that's where you get into a problem where now at some point you're protected. It's kind of like an insurance policy where you would say, you pay a deductible of $5,000, and then we'll pay the next $15,000 of your cost, and then you're going to kick in and pay the next $100,000 of loss. Well, that sounds like a dental insurance policy to me, more so than like a health insurance. You never know what can happen and how far the markets can go down. And so having a passively managed, what you're calling collar with a kicker, is dangerous in our opinion, because you are potentially going to jump right in and start losing the same amount that the market loses if that is passively managed during the time that you have that on. Now you get to reset it, but you can accelerate or even lose more money than the market under some scenarios with that happening. So what we like to do is we like to separately actively manage that put and call. If you are willing to take that off as you get close, then you start to accelerate and have a higher downside capture ratio as the market's going down with that hedge on in the equity and selling that put. You've got your premium from your call. That's depreciating. You're making profit on that call that you sold the collar, but then the put kicker, you start to lose money, and that's going to lose money quicker probably than your call is depreciating. So in that particular scenario, we're more than happy as an active manager to flatten that trade out, to take that put off, to kind of reset, to put another strangle on that's bounding the current market, instead of, let's say, in 2014 with these massive declines with V-shaped recoveries. Under that scenario, a passive manager would just let it go, and it's going to, they're going to give up whatever the put is going to lose for them, which is pretty much equivalent to the stock that you've bought. So you're losing what the market's losing with large losses. We yank that off. And so while we may decline in lockstep with the market for a very short period of time, that's gone. And then our hedge kicks in, and it's a full-blown hedge at that point, and it protects us exactly as we expect. So we're not willing to allow that kicker to kick us, in a sense. We take that off in the same way that we would take that off or adjust the upside call to make sure that we are not truncating our upside very much, and that we're not participating in the downside like that, but that our insurance policy, which clients pay us to implement, which I'm using that as an analogy with respect to the hedge, is actually delivering like insurance that they know and understand.
Yeah, well said. Of course, it is a challenge whenever you have any short legs in a position like a spread or the covered call in this case, particularly when you're talking about selling a put. You're right, in that farther out region of the downside in an equity or in an index, because that's where, as anyone knows, there's a lot of volatility premium, and that tends to blow up very quickly if things start moving against you. So you're right. If you're going to do these types of strategies, you have to be committed to the fact that you're going to be essentially managing things a little bit more aggressively. But that, again, could be a good thing in this scenario, as you'll see a little bit in the Buzz segment. But before we get to the Buzz, really quickly to wrap up here on the high net worth, we kind of touched on a variety of different options-based scenarios for people who have concentrated stock positions, and they could use, obviously, these strategies. They could buy a put, they could sell a call. So they're probably only primarily concerned about tax consequences. But for those people, Rob, like you mentioned at the top of the segment, who come to you and have prohibitions, and I'm sure a lot of our advisor listeners listening, I should say, have come across those types of clients. Do you have any quick advice, any quick tips for them when they're constructing options-oriented positions, trying to go out and find some sort of similar type position to hedge and going that way instead?
Right. So, we are faced with this quite often. We would love to hedge with liquid options that are directly on that underlying, because in that case, you're basically covering all the risk, whether it be market risk or company risk. And so sector, market, and company are all covered by using, an option on that specific underlying. But in cases where we cannot do that, then we're always looking to what's the next best thing. Well, maybe you're going to want to hedge with the sector and market. We know that long-term puts are going to hedge systematic market risk, and is the only appropriate way to do that. Systematic risk is also called undiversifiable risk. So don't expect that you can diversify when all the markets are tanking because of some geopolitical scenario or big risk financial collapse or something like that. So in that case, we're looking at maybe doing something in a sector. So in the energy sector, if you had something like BP stock, we might be looking to hedge that with something like XLE. At least we're picking up then the sector risk protection as well as market risk, even though we wouldn't be able to cover something where if BP had an oil spill like they did several years back, that's going to be might affect the sector a little bit, but you're going to be uncorrelated. So you need to be careful that you're not that the client understands that what you're covering is for market risk and systematic risk and sector risk in that scenario. And then we typically, if this is a CEO or executive, they're pretty confident in their own ability to manage their own companies, and they generally believe that everything is going to be, other than things that they can't control, everything is going to go well. So they're willing to accept that type of responsibility, that we are not covering their company's specific risk under that scenario.
It is a shame that some regulators and some companies still don't allow the put buying when it's a demonstrably different thing than outright selling your shares. I mean, the executive should have some skin in the game. That makes total sense. I understand that prohibition where they can't sell with any sort of filings and things like that. But the hedging with the put, I think, should be viewed a little bit differently. Maybe you disagree, Rob, because they still have skin in the game. They're still there. They're still participating, obviously, but they're also using proper risk management. And I don't see the downside in that, pun intended. But of course, it's a different thing from a compliance and regulatory perspective. Maybe we'll get there someday, Rob, where they treat buying a put a little bit differently than they do now. You think we're making progress on that front, or you still kind of think we're going to be in this regime for a while?
I think we're making progress on that front, but I think that a lot of people would love to see that the executive, if the shareholders suffer because of a major decline, that the executive suffers in lockstep. So having just tying their upside together is one thing, but I think they also want them to suffer if the market goes down. So obviously preventing them from shorting the stock or buying puts really has all of their skin in the game, which that's unfortunate. We don't think, even a company should be hedging their own risk in a variety of ways. So, we would like to see it move the other way, but we just deal with whatever the restrictions are at the time.
Yeah, I guess we're preaching to the choir in that sense, and I can certainly see there is that element out there that wants people to pay for their missteps, and I agree. You don't want someone to do something dubious and have a bunch of puts in his back pocket, so he's not worried about it. But still, at the end of the day, it is something I think that should be encouraged. And you're right, maybe more companies should be actively out there hedging their stock exposure as well. I think that would be a great thing for a lot of people, not just the options market, but for a lot of companies out there to insulate themselves in some of these unanticipated risks out there in the global marketplace. Speaking of the global marketplace, Rob, it's time for us to move on to our next segment. It's called The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, and welcome to The Buzz. This is the portion of the program where we break down the news that's going on from the world of options and wealth advisors that you may not have a chance to see as a busy wealth advisor, asset manager yourself. You don't have time to keep up on the latest developments. So we do it for you. And speaking of the latest developments, right now as we're recording this, it is mid-June, and we are right about to start the big Invest conference out there in New York, of course, a big wealth advisor summit. And Rob, I was looking over the agenda before we started the show here, and there's a lot of different topics. I mentioned the Robo Advisor thing. It's kind of top of mind for everyone in the wealth advisor community right now. You can't really escape it. Everyone and their mother is going on about it. There's talk about Google perhaps getting into the space. So as you might imagine, a lot of the panels, a lot of sessions there are oriented, I should say, toward that risk to a lot of advisors. What can you do? What can you do to avoid it? Well, luckily you're listening to the right show. We've already showed you some ways you can go about avoiding it. But of course, they also have a lot of panels on digital technology, essentially mobile apps for advisors, and exploring the unique needs of high net worth clients, something we just touched on here a little while ago. But you know what's not on this agenda anywhere, Rob, and it probably doesn't come as a surprise to you, may come as a surprise to some of our listeners. Pour through all of that, there's nothing on there about anything that we talk about here on this program. None of the hedging, none of the options-oriented type of instruction that, quite frankly, a lot of these guys need. In fact, there's no alternatives anywhere on the agenda at all. I wouldn't mind if they just lumped options in with everything else. The MISC panel, that's fine. At least have something. But they have nothing there, and that's kind of par for the course still in a lot of the broad financial advisor community. They still, to my mind, Rob, are kind of caught in the 1973 perspective. They're talking about everything else under the sun except for how they can use these options, particularly in this environment right now. The market's getting a little bit top heavy in a lot of people's eyes. People are concerned. They're sitting on a lot of profits. They may want to hedge that, and this is a good time to have that conversation with them. And if you're focusing on all these other things and not on how you can actually do this for them, how you can actually provide that value-added service, I mean, the best way to fight back against these automated platforms is to provide a unique service that they cannot. And that's exactly what we're talking about here on this program. So I don't know, Rob, does it frustrate you like it frustrates me to see a lot of these major asset management, wealth management, financial advisor type firms and events and conferences, et cetera, still being very slow to the options party, for lack of a better term?
I'm definitely have to kind of calibrate myself for very slow movement and see small changes as being significant downstream. I think the way that we've identified or differentiated ourselves is not only because we're offering a sophisticated option strategy, but that we've also invested heavily into proprietary technology in-house that allows us to manage this type of a strategy. We don't let our technology limit us in terms of what we could do. We go and design technology that basically allows us to do what we're doing, and it's just not available out there. So an advisor may have a desire to implement, let's say, an iron butterfly or one, a strangle or something like that. But what's going to help them to manage that? There's almost nothing out there similar to the robo advisors or the automated or system tools that allow people to calculate the size of the trades necessary for each individual client account according to what they have. So they end up having to do this in spreadsheets manually, and it's a huge overhead process that is potentially full of errors and mistakes, and you don't know somebody took out money or put in money. And so ultimately, I think technology severely limits the ability for advisors who want to use options to go out and employ some of these strategies. And I would love to see, I hate to see robo option, but I think that at some point there's going to be things like that, and we are designing things in-house for our own use that streamline our processes and allow us to do things at a very large size and thousands of accounts that we would like to see adopted in the industry. But we definitely appear to be unique in that area. Even back, with people that are just doing baskets of stocks in very large firms and making calls in their models, they're doing things in spreadsheets. Well, that spreadsheets to us are more like rapid prototyping and are not really, on par with what they're doing in the, digital technology, the robo-advisor. So we would like to see that expanded. And when it eventually does, then I think these strategies will be much more accessible to clients and managers.
Maybe that strategy you were talking about before, kind of the quarterly set it and forget it collar or zero cost collar strategy. Maybe that will be the point of entree for the robo advisors in the option space. That's a computer can do that. It can calculate zero, so it can find a put and a call and that offset each other or very close to it and write those every quarter. So maybe that'll be the point of entry. Again, another good reason why, if you're thinking about adding options into your portfolio and for your clients' portfolios, have the active management component, because that's where you can really set yourself apart from any other type of robot platform, for for lack of a better term. I hate that term, but it seems so ubiquitous you can't really escape it. Another one, this was sent in actually by a listener, Rob. He wanted us to talk about this a little bit on the show. This kind of gets to the trends going on in the wealth advisor space. We're talking about robots being out there, automated platforms. We were talking earlier about using listed options to hedge high net worth concentrated positions in stocks. But another interesting trend we're seeing out there is that some more managers are starting to use more derivatives, but on the OTC side of the fence, of course, the over-the-counter stuff. And when we're talking those, we're talking a little bit different ballgame than what we're talking about here. A lot of the talk when people say OTC derivatives, they really mean the CDSs and the credit default swaps and the interest rate swaps, because that's where the lion's share of that business takes place. And those are a really kind of poor man's derivatives, for lack of a better term. They don't really fall into the same robust category of like a listed contracts we're talking about here, with all the different things we talk about with theta and gamma. There are some components to that, but they're much closer to a binary type product than they are what we're talking about here. But that said, there is a lot of volume going up in that space these days. Let's see some numbers here actually from the article listeners sent in. The notional value of OTC contracts up some 60 trillion to 710 trillion from 3 years ago. That's even with a lot of compression going on in that space. If you've been paying attention to that space, listeners, there's a lot of talk about clearing these things post 2008, when a lot of those blew up in the faces of a lot of firms that were selling credit default swaps essentially to every other firm on the street with no way to hedge them themselves. Now we're seeing a lot of those firms having to use central clearing and everything else to try to reduce that risk, compress a lot of these swaps down so the notional value is not that as big as it once was. And even still, the numbers are growing, and we're seeing more advisors getting into them because exactly of that reason. The counterparty risk was always the big issue with those. If firm X sells you a credit default swap, well, they have to be around when you want to collect on it. And in 2008, a lot of those firms were not around. So the counterparty risk became very stark. And so people are scared about that now with the central cleared contracts. It has helped that a little bit. Rob, this is something we don't talk about that much on the show because, like I said, we mostly focus on the listed stuff. But that said, have you guys ever utilized a lot of OTC stuff? I mean, where you guys do a lot of the big S&P type stuff, there is an active market for that OTC. Obviously, maybe someone comes to you guys with kind of a unique portfolio, and you guys, it doesn't fit in with the listed contracts that are out there in SPX or others. Maybe you want to put together some sort of customized hedge. Do you guys ever utilize those products, or are you exclusively on the listed side?
Well, I would say that we're definitely exclusively on the listed side. It's, I'm always happy to see appropriate use of derivatives. I hate when derivatives get the bad name fall guy because somebody's using excessive leverage or they don't really know what the counterparty risk is. We believe that an active, sophisticated manager who's doing right by their clients are going to look at these instruments and use them where they're appropriate. We happen to find that most managers, most portfolios that come to us would be, benchmarked against the S&P 500 or have a collection of emerging market and gold and REITs and, it's all the major baskets that everybody's familiar with, which there are plenty of listed options that basically we can use. So we have not run out of tools to use with respect to our core strategy or overlay strategies. The other issue is that, which will segue into your kind of maybe your next topic with respect to the SEC scrutiny on funds and use of options, is that anything that basically would contribute to or have issues with counterparty risk or transparency or liquidity. The spreads are really wide, slippage is really large. You're having a hard. You can only use this broker to trade that particular OTC instrument. Things like that all contribute to that uneasiness and lumping in all derivatives into the same boat. And so us getting onto platforms, us basically trying to fight the concept that, the evil derivatives were responsible for the financial crisis. Those are really more tied to some of these less regulated, less transparent derivatives. And so that kind of works against us. We're trying to grow a core strategy, core use, acceptance of options out there. And we don't believe that, SPY options, SPX options, had anything to do with the financial crisis, and yet people, for simplicity's sake, just want to lump all derivatives in together. And so That's one of the, I don't have anything necessarily against them if they're used in the right way. Just like electricity, you wouldn't think about living without electricity, but you could still kill yourself with it. So we're trying to stick with things that are much more mainstream and that we could very easily answer the counterparty risk and liquidity and scalability and slippage and everything else very easily, and make clients feel more comfortable instead of less comfortable.
Well, that certainly is an important thing, particularly when you're dealing with the dreaded D word. Derivatives is a reason why we don't call this the Derivatives Insider Radio Network, because you're right, that's a very loaded term. People hear that word and they tend to run for the exit, sometimes clients included. So you're right, you have to definitely be very careful with what you use. And you're right, the OTC stuff, it still is dubious, and it was to blame for most of the meltdown we saw in 2008. You're right that people paint with that broad brush. They hear derivatives, they think a credit default swap is the same thing as a front month at the money SPY call option, and they just lump them all together, when in reality they're night and day, and yet people don't see that distinction. Speaking of seeing distinctions with derivatives, you mentioned it here, let's get into it. We're seeing other developments here in the asset management space. The SEC, I think the commissioner, actually Kara Stein, they're trying to start homing in on the derivatives exposure that's lurking in a lot of these funds. We see a lot of the reasons people who are anti-derivative for whatever reason, they go to other products, they go to mutual funds and others trying to seek some sort of safety without really realizing at the end of the day that a lot of those funds are still out there doing what we were just talking about, buying puts to hedge, selling calls to generate income. It's a very common strategy. So there's a lot of derivatives exposure out there in a lot of these products, particularly some of the more esoteric ones, the inverse and others, the 1x2 north, 1x2 positive one, the inverse 2 to 3 ratio down type ETFs. How do you think they generate that leverage? Well, of course, they use derivatives. So some SEC commissioners, including this woman, Kara Stein, are looking to investigate that more. What they say here is saying the commission should consider whether mutual funds that act like hedge funds but offer the liquidity of traditional funds are endangering investors. They say some funds which use complex strategies or invest in assets that are illiquid, quote, often operate in a gray area of mutual fund regulation, and the SEC could propose new rules on their liquidity and, of course, the use of derivatives in funds. That is indeed the dreaded D word, and also purporting some new reporting rules for separately managed accounts. So this kind of gets to what you were just saying, Rob, kind of lumping the good with the bad when it comes to derivatives. That's why I think you're right, for a firm like yours to use a lot of listed, liquid, clearly and demonstrably verifiable type products. Probably a benefit for you guys at the end of the day, or some of these other funds that are out there that are kind of using some, let's say, less liquid products. It certainly can become a problem, particularly if you don't disclose it in a lot of these areas. Obviously, this is your bread and butter right here, Rob. This is where you guys live. So I'm curious, what are your thoughts on perhaps the SEC drilling down a little more into particularly the use of derivatives in a lot of these funds out there?
Well, so we're very confident that our strategy, looking at our long-term track record, our standard deviation, if we were using massive leverage or had some scary thing lurking in the closet, you would have seen it through things like flash crashes and financial crisis, where our hedge didn't work, which it absolutely did, one of our best years. But, over such a long period of time, you would actually see that we were not using things in the appropriate way. We believe, again, I'll use the electricity analogy. You wouldn't think about not having it in your house, but you could definitely kill yourself with it. Without considering what strategy is being employed and what securities are being held, I think it's inappropriate to characterize and say any mutual fund that includes options is basically acting like a hedge fund and endangering investors. That's just flat out not the case. And I think that casual or cavalier view of or lumping everybody in with everybody else, I mean, that's like saying every mutual fund is the same because they're all trading securities. I don't even know how to answer something like that. So I am totally open to the scrutiny and the looking at what represents a good strategy versus a highly leveraged strategy, and making sure that clients properly know what they're getting into. And maybe that means that the industry has to do a little bit better job of explaining what exposure means in strategies that are holding derivatives. You can't just go in and use notional exposure of what you're holding in, let's say, your short put, and say, well, if the market went down to zero and you did nothing with that short put, then you basically have a particular notional exposure, and it would, in a sense, it would wipe out your hedge. So by other than that spread that we're talking about. So but that's not appropriate. You have to consider the strategy. If your strategy and your rules have you getting out, let's say, 30 points away from your short strike in that case, then you can't extrapolate a loss in that put all the way down to zero in the way that they try to do. So I'm all for the industry coming to grips with how, what the appropriate way to assess exposure and risk in a particular strategy is, and not just looking at the options or securities that are being held at any given point in time. And when we get that, then there'll be probably a better idea. Clients will benefit, and strategies like ours will not have to go through the ringer, so to speak, of trying to prove that we're not just like credit default swap scenarios back in 2008 and 9. So we are somewhat tarnished. Anybody who's trading option is somewhat tarnished by that lumping together of everybody, that's using options into the same strategy. I mean, obviously, farmers have been using options for years and years to hedge their crop risk. That's not the same thing as somebody ratcheting it up and selling a 5-to-1 ratio on the equity that they're holding in a strangle, and hoping that they're going to make a huge amount of money in a very short market, movement. That's different. And so we've gotten hit with this, and there's a lot of firms out there that that are, let's say, approving funds getting on their platform, and it's made it very, very difficult as they've taken a step back and said, we need to revamp our entire due diligence process. And now the DDQs to get such a fund, which like our fund on some platforms, takes months and months and months and months, instead of if I had some terrible stock picking mutual fund, I could get it on the platform within a couple weeks.
Well said. As usual, I know this is an issue that is near and dear to your heart, and you're right. It is nice on one hand to welcome more scrutiny to get some of the bad actors out of the space, but everyone who's been in the options and derivatives world for a while knows that increased regulatory scrutiny, they don't really treat the different products differently. They treat the good and the bad with equal scorn, derision, lack of understanding, whatever you want to call it. And so the good sometimes gets thrown out with the bad in this case, and so people are understandably a little bit reticent of more SEC involvement in this space as a result. They haven't really established a good track record when it comes to options and indeed derivatives in the past. Hopefully that will change, but still, it's not always a welcome thing to see more regulators sniffing around, throwing around that dreaded D word, because we know where that goes. But that said, it may have some interesting developments. We'll have to stay tuned for that. Unfortunately, that's about all the time we have for the Buzz segments. Also all the time we have for this episode of the Advisors Option. A lot of great stuff going on in today's episode. I know you guys wrote in a lot of great questions. Don't worry, we'll get to them on the next episode. But before we go, as always, Rob, I know you guys are cranking away on a lot of interesting things over there in the land of Swan. Really quickly, leave our listeners with a little bit of a tease of what they can look forward to from you guys over there at Swan in the coming month.
Well, lots going on. We rolled out a new fund executing our existing strategy that we've been running for 17, 18 years on the S&P 500. We rolled out in the emerging market space. We're looking at launching 2 or 3 additional funds probably by the end of the year. We're looking at developed. We're looking at U.S. small cap REIT. We basically are applying our strategy in a CIT, which is a collective investment trust format that's going to be rolled out as alternative to 401k program. It'll be the first of its kind that we know of. Typically you're finding things, you're 60-40, 80-20, just, pretty bargain basement, very unsophisticated strategies. So we're going to be rolling out a pure Swan defined risk, 5 different options for strategies in that space. Super excited by that. We continue to grow, and we plan to apply our basic core strategy that involves many of what you've talked about today, many things of what you've talked about, to as many asset classes as we possibly can find.
All right, listeners, if you want to check that out, of course, head on over to their new site, the Swan Global Investment. Just search for Swan Global Investments. It's an easy way to do that as well and find all that information they have there, including all of the details on how their strategies are performing and everything else over there. Good stuff. SwanGlobalInvestments.com to learn more. And on behalf of Rob and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great questions. Keep them coming. We read them all. Even if you don't have a chance to answer them on the air, we try to respond as many as we can. And we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.